Every financial influencer is screaming, "Do your Roth conversion now." The smart retirees are ignoring all of them. For the past 8 years, the advice has been relentless. Convert your IRA to a Roth before tax rates go up. Lock in today's low rates before the Tax Cuts and Jobs Act expires. Do it now. Do it urgently. Do it before the 31st of December. Do it or you will spend your entire retirement overpaying the IRS while your neighbor who converted pays nothing. Millions of retirees listened. Millions of retirees paid big tax bills. Some of them did exactly the right thing and will benefit for decades. And some of them, nobody is talking about this part, paid taxes they absolutely did not need to pay, triggered Medicare premium surcharges that cost them thousands more, and made a permanent, irreversible financial decision based on advice that did not account for their specific situation. And now, in 2026, the One Big Beautiful Bill Act has made current tax rates permanent. The urgency argument, convert now before rates rise, is gone. And a surprising number of sophisticated retirees are stepping back, looking at the new landscape, and concluding something that sounds almost heretical in today's financial media environment. Wait, or skip it entirely, at least for now. This is not the advice you will hear on most channels. It is the advice that actually makes sense for a significant segment of the retirement population in 2026. And by the end of this article, you will know exactly whether you are in that segment and what to do instead. The reason everyone was rushing, and why that reason just evaporated. To understand why smart retirees are pausing, you first have to understand why everyone was rushing in the first place. The Tax Cuts and Jobs Act of 2017 lowered income tax rates significantly and was scheduled to expire at the end of 2025, reverting to the higher pre-negative 2017 rates. For financial planners, this created what seemed like an obvious opportunity: convert pre-tax retirement money to Roth accounts at today's lower rates. Pay the tax now and then enjoy tax-free withdrawals for the rest of retirement, while everyone else paid taxes at the higher rates that were coming. It was a compelling argument. For many people, it was the right strategy. Then came July 2025. The One Big Beautiful Bill Act made the prior tax rates permanent, removing the urgency of the 31st of December 2025 low tax conversion deadline. The expiration that was driving the urgency did not happen. The rate increase that made converting now so obviously correct did not materialize. The fundamental premise underlying years of urgent conversion advice changed overnight. For 8 years, retirees were told that taxes were going up in 2026, and that the solution was to do Roth conversions before that happened. With the permanent lower tax rates now in place, the question became, is the Roth conversion party over? The answer is nuanced, but for a meaningful segment of retirees, the answer is yes, pause. And here is why. The hidden tax bill nobody warned you about, IRMAA here, is the conversion consequence that catches the most people off guard, that many financial advisors who are not specialists in Medicare fail to mention, and that has cost retirees thousands of dollars they never anticipated paying. It is called IRMAA, the Income-Related Monthly Adjustment Amount, and it is the reason that a Roth conversion that looks perfectly reasonable on a tax bracket spreadsheet can turn into an expensive mistake when you factor in the full cost of the decision. Here is how it works. Medicare Part B premiums, which are automatically deducted from your Social Security check, are not flat for everyone. They are income-based. If a Roth conversion raises your income above certain levels, you could face surcharges on your Medicare Part B and Part D premiums 2 years down the line. These surcharges apply to single tax filers with a modified adjusted gross income above $109,000 or married filers with a MAGI above $218,000, 2 years. That is the look-back period. The Medicare premium you pay in 2026 is based on your income in 2024. The premium you pay in 2027 is based on your income in 2025. So a Roth conversion you do in 2025 creates a Medicare premium consequence you do not see until 2027, at which point most people have completely forgotten the connection. What often surprises retirees and even their tax preparers, that Roth conversion income could cause Medicare premiums to go up. What many people do when considering conversions is say they are in a particular tax bracket and will convert to the top of that bracket but not go into the next one. This sounds reasonable, but near the top of the 22% tax bracket is the first IRMAA threshold of $218,000 for joint filers and $109,000 for singles. The complication is that MAGI is calculated before deductions, while tax brackets are based on taxable income after deductions. Someone focused on taxable income might think they are in the clear going to the top of the 22% bracket. but their magi could already be above the IRMAA threshold. In practical terms, a married couple who converts to the very top of their tax bracket, following the advice that sounds completely reasonable, might find themselves paying IRMAA surcharges they never anticipated because their magi crossed the threshold, even though their taxable income stayed within the bracket. The IRMAA surcharges are not trivial. Additional income from a conversion can potentially trigger a surcharge on Medicare premiums, as well as an additional tax on net investment income called the net investment income tax, or NIT. Depending on income level, the combined effect of IRMAA and NIT can push the effective tax rate on a Roth conversion well above what the stated bracket would suggest. The new tax law created new deductions that changed the math. The One Big Beautiful Bill Act did more than make current tax rates permanent. It introduced new deductions that directly affect the Roth conversion calculation, and that many retirees have not yet incorporated into their planning. The tax legislation passed in July 2025 made permanent the existing 7 tax brackets and added new deductions relevant to investors considering Roth conversions. These included the senior tax deduction, an additional $6,000 deduction for those age 65 and older, effective through 2028, raising the state and local tax deduction, which had previously been capped at $10,000 to $40,000 through 2029, and adding an itemized deduction cap that limits the value of itemized deductions to 35% of every dollar of income, effective in 2026. The senior deduction is the most immediately relevant for most retirees. It phases out starting at $150,000 of modified adjusted gross income for married couples filing jointly, and $75,000 for single filers. Income above the senior deduction threshold reduces the deduction by 6% of the excess income until the benefit fully disappears at $175,000 for single filers and $250,000 for married couples filing jointly. Here is why this matters for the Roth conversion decision. If your income is below the phase-out threshold, you qualify for the full $6,000 senior deduction per individual, up to $12,000 for a married couple. A Roth conversion that pushes your magi above the phase-out threshold not only triggers higher taxes on the converted amount, it also reduces or eliminates the senior deduction you would otherwise receive. That is a double cost that does not show up on a simple tax bracket comparison. The raised SALT deduction is also income dependent and phases out. The SALT deduction phases out starting at modified adjusted gross income of $500,000 or $250,000 for married filing separately. Income above the SALT threshold reduces the deduction by 30% of the excess income. For retirees in higher income states whose Roth conversion might push them toward phase-out territory, the SALT deduction reduction is an additional hidden cost of converting. The new itemized deduction cap, limiting the value of itemized deductions to 35% for higher incomes, creates yet another layer of complexity. Both the new deductions phase out at higher incomes, which means that the same Roth conversion that generates a specific tax liability at the stated bracket rate can simultaneously reduce 3 different deductions: the senior deduction, the SALT deduction, and the value of itemized deductions, resulting in a total effective tax cost significantly higher than the marginal rate suggests. When weighting actually wins, the retirement income valley here is the argument for patience that the conversion now crowd consistently underweights. For many retirees, the optimal time for Roth conversions is not while they are still working and in their peak earning years. It is in the early years of retirement, before required minimum distributions begin. For some retirees, the best time to convert assets to a Roth is during the retirement income valley. The retirement years before required minimum distributions begin at age 73 or age 75 beginning in 2033. Some retired clients have years where they are living off their brokerage account assets and paying a 15% tax rate on long-term capital gains or dividends. Think about what that means. A retiree who leaves work, has not yet claimed Social Security, and is living off taxable brokerage accounts may find themselves in a dramatically lower tax bracket than they were in during their working years. Their pension income has not started. Their RMDs have not started. Their Social Security is not yet being received. Their total taxable income is the lowest it will be for the next 20 years. That is the moment for Roth conversions. Not during the final working year when salary is at its peak. Not in the first year of retirement when severance, accumulated TO payouts, or final bonus income may still be landing. The moment is the low-income valley years, typically ages 65 to 73, when all the big income streams are either not yet started or deliberately managed. A simple but powerful question to ask is, will my tax rate be lower after I retire than it is now? If the answer is yes, waiting may be the smarter move for workers in their peak earning years who will see a significant income drop in retirement. The answer to that question is often yes. And if the answer is yes, converting aggressively while still working means voluntarily paying higher taxes today than would be necessary in just a few years. The permanence problem. There is no do-over. Every argument for pausing or reconsidering a Roth conversion ultimately rests on one foundational fact that the conversion now narrative consistently glosses over. The Roth conversion is permanent. Once you do it, there is not a fix. There is not a do-over. Before 2018, there was a mechanism called recharacterization that allowed you to undo a Roth conversion if it turned out to be a mistake, if the market dropped after conversion, if your income came in higher than projected, if IRMAA surcharges materialized unexpectedly. That option was eliminated by the Tax Cuts and Jobs Act and has not been restored. The conversion you make in 2026 is final the moment you make it. This permanence is the reason that the urgency narrative is so dangerous. When a financial decision is irreversible, the asymmetry of outcomes matters enormously. If you convert and it turns out you should have waited, you cannot fix it. If you wait and it turns out you should have converted, you can still convert next year. The optionality of waiting has real value, and it is systematically underweighted in advice that emphasizes urgency. The issue is not paying taxes. It is paying more tax than necessary at the worst possible time. A Roth conversion made at 63 while still earning a full salary that crosses the IRMAA threshold, reduces the senior deduction, triggers the NEAT, and pays a real effective tax rate of 32% or more. When the same conversion made at 68 in the retirement income valley would have been taxed at 22% or less, is a permanent overpayment. There is no mechanism to recover it. So who should skip the conversion in 2026? The answer is not everyone. Roth conversions are genuinely valuable for specific situations. But the list of situations where skipping or pausing is the smarter move is longer than the conventional advice suggests. You should seriously reconsider converting in 2026 if your income is near any IRMAA threshold and a conversion would push you above it. The combined cost of higher taxes plus Medicare premium surcharges typically makes the math work against converting. You should pause if you are still in your peak earning years and expect a significant income reduction in the early years of retirement. The retirement income valley is a far better moment for this strategy, and doing it now means paying unnecessarily high taxes. You should reconsider if a conversion would reduce or eliminate your senior deduction under the new legislation. The $6,000 deduction that disappears at higher MAGI levels represents real money that should factor into your effective conversion tax rate. You should stop and run the full numbers, including IRMAA, NEAT, deduction phase, outs, and state taxes. Before converting, never assume, always project. Project out your tax situation, preferably with a financial advisor who uses forward projecting tax software. And if your projections show that your retirement income tax rate will be lower than your current working year tax rate, which is true for more retirees than the conversion now crowd acknowledges, then waiting is not procrastination. It is strategy. The bottom line, the urgency of the 31st of December 2025 low tax conversion deadline is gone. But the need to project out your future tax situation so that you intentionally pay taxes when your rates are expected to be lower will never go away. The smart retirees skipping Roth conversions in 2026 are not abandoning the strategy. They are executing it with precision rather than urgency. They are asking when, not if. They are running the full math, including IRMAA, deduction phase, outs, and the retirement income valley years before making a permanent, irreversible decision. The conversion now crowd will tell you the best time was yesterday. The smartest retirees know the best time is whenever the math actually works in their favor. And for a large number of people in 2026, that time is not today.